Markets closed the 2021-22 financial year on a strong note, with frontline indices S&P BSE Sensex and Nifty 50 gaining 18% and 19% respectively. After markets posted a double-digit return for the second consecutive financial year, analysts expect the next 12 months to stay turbulent as higher inflation and rising interest rates cloud bourses. Market veteran Ambarish Palega too expects flat or negative market returns in FY23. Listen in.
FY23 could be a difficult year for businesses as well as markets. The disruption in supply chain caused by the sanctions which followed the Russia-Ukraine war, I think the pain will be felt for the next few quarters. There's a huge cost push inflation which most of the customer-facing businesses will find it difficult to pass through immediately, resulting in squeeze in margins. Again, FY23 could witness the change in the world order. We may look back at the year and say that this possibly was the start of the decline of US dollar. Overall, the global trade will not be the same from FY23. This will cause disruption initially, the brunt of which will be borne by the businesses as well as customers. Stock markets after 2 years of stupendous returns may be flat or possibly give negative returns as businesses adjust to the new normal.
Analysts believe inflationary pressures are expected to cast a shadow on India Inc. earnings this fiscal year despite reopening of economic activity. Corporate profitability remains at stake as companies hesitate to take price hikes. Given this, several brokerage firms have downgraded earnings outlook as companies expose themselves to increased margin pressure. Morgan Stanley has slashed earnings growth forecast by 8% for FY23. Meanwhile, Motilal Oswal too has cut earnings estimate for automakers due to fuel price hikes. Vinod Nair of Geojit Financial Services warns margin pressures and muted consumer sentiment to lower FY23 earnings roadmap. Listen in.
Currently, the market is expecting an earnings growth of around 15 to 18% during FY23. However, there are downgrade risks to the growth forecast due to high inflation. Inflation will generally help the corporates to report higher revenue growth, especially for companies associated to metals, mining, soft commodities and consumer goods, but it will impact the overall margin, profitability and demand of the economy. So there are downgrade risks. Some breather is that earnings forecast for the banking sector is very robust, which has a high mix of the total corporate financial numbers. This will help to maintain the overall trend. Also, any relief in the war, inflation and improvement in global supply chain is also expected in the future, which will also reduce this risk based on the developments.
Moreover, with global central banks increasing interest rates, India too will be walking a tightrope to control inflation and sustain durable growth. The Reserve Bank of India will hold 6 Monetary Policy Committee meetings in FY23 starting from April 6 to 8th. Though analysts expect the central bank to defer rate hikes for the latter part of FY23, investors will watch out RBI's commentary on inflation forecast. On the other hand, after a blockbuster FY22 for the primary markets, FY23 will see over 50 companies heading to bourses to raise funds, including the much-awaited LIC IPO. That said, a section of analysts expect equities to remain a favorable bet in FY23 as markets have priced in the bad news. Manish Jain, fund manager at Ambit Asset Management, believes strong rural demand and credit growth will steer markets forward. Listen in.
So I do believe that after the correction that we've seen in the last couple of months, the markets are now factoring in all the bad news, both from India as well as from a global market perspective. The Russia-Ukraine war situation, the commodity cycle, the rising interest rate scenario, as well as the inflationary pressures that we are going to anticipate are more or less now priced in. From a next year's perspective, I do believe equity markets look very, very well poised from a risk-reward situation perspective. We would expect the overall earnings to continue to grow at 12 to 13% pace for a market that is priced in at around 18 to 19 times. I think from a PEG perspective, that's very, very favorable. Plus, we would anticipate a strong revival in rural demand, continued strength in discretionary consumption, a strong pickup and a sustainable pickup in credit growth in the banking system, as well as a revival of the private sector capex. So overall, the right time to invest is now to make significant amount of money from the next couple of years perspective.
Against this backdrop, what trading strategy should investors adopt in FY23? A.K. Prabhakar of IDBI Capital shares his investing tips.
For me, IT as a sector is very attractive. Even pharma, I think, is very attractive. They have not rallied also. Life insurance, as COVID is behind us, life insurance is one segment we need to concentrate. Defense manufacturing, if you get good companies there, these are the sectors you have to be. But other manufacturing sector, anything connected with crude, which is very volatile, I would avoid at this point of time. Even banks, I will be selectively bullish, not overall I will be bullish, because rising interest rate can have an impact on them.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.